Hello and welcome to the channel. This is my understanding of the market. I kind of want to share this with the rest of the world. A lot of this has to do with some things that I've seen over time, learned over time. One of my most favored methods of risk control is hedge trading. First off, I just want to start and say that no matter what strategy, method, system, or thought process you're using, every trade has the same potential to win or lose. No results are ever typical, and no results are ever promised or guaranteed. All trading is risky, you can lose your money very quickly. Act at your own risk. Not a financial advisor, just some random person with a trading account. Okay, so let's get started and get right into it. First with the who, what, when, where, why. So who is hedging really for? Hedging is for a trader with a full understanding of the market who's looking for a better way to preserve their capital and apply safer risk management. Basically, hedging is just another form of risk control, just like stop losses and everything else in the market. Unlike a stop loss trade though, it's going to put your position on pause. It's going to basically stop the loss of equity until you can get another opportunity to get a possible gain out of the position. All right, here's a perfect example of a basic hedge. This is the most basic form of a hedge that you can have. It is the building block of all other parts of a hedging strategy. It is all based on this one single concept. So let's say, for example, you have price. It's coming down, and you have a level marked out here from before from a previous area, and you think that it's showing rejection here, giving some good signs in a candlestick pattern or a double bottom or whatever type of pattern you want to use to try to trade this with. And you think that based on all your information that it's going to reverse and go up. So you buy right here for price to go up. Okay. Now, just like a normal trade where you would have a stop loss down in this area, instead of using a stop loss, you're going to place an equal and opposite type of order that is the same size as this trade. So that if you were trading one lot for a buy order and you had a 20 pip stop loss on a normal trade, then where you would normally put your stop loss, instead of stopping out, you will put an equal size sell order below. And that is the hedge. Now, let's say, for example, price starts going up. You think you might be right. It breaks out a little bit, comes up, and then suddenly it falls down. All right, now you get hedged. Now you have a drawdown now of 20 pips. So at this point, the whole idea of what you want to do is you want to keep waiting until price starts working around and gets to another level where it's likely to possibly reverse in your favor. So let's say it's done this here and you're starting to think now it's going to go. So what you will do is this order here, let's say that this whole distance is 80 pips. So had you not had that sell stop in place, you would have lost the 20 pips. And if you didn't have that sell order in place, you would now be down a total of 100 pips for that one lot position. But with the hedge, you prevented this 80 pips of loss. So now that we're at another point where you think the market is likely to reverse in favor of the buy, you would close out the sell hedge position. That will then move into the drawdown and increase the account balance, but it won't change the equity. So basically at this point you would have two choices. You could but since we're sticking with the most basic form of hedging right now, we're going to say you just have one choice. You're going to take that same idea now at this level, and 20 pips below that, or however much you need for a stop loss there that you determine, you're going to place an additional sell order. Now remember, this one's gone. It's already cashed in. Now all you're trying to do is wait for that price to come back up 20 pips. That's all you need. Once you get price coming back in favor of this position for 20 pips, close that position out there. So this is exactly how you would use a basic hedge, and the entire basic idea behind why you would hedge. So now, instead of losing that $200 from the 20 pip stop size at one loss, if you were trading Euro USD, for example, you saved that in your drawdown. Then this $800 from the 80 pips at one lot, you never lost. You held the account still. Then you closed out, which was protected from this 80 pips of movement. And then when the 20 pips come back, you did not lose that $200 and your account stayed exactly the same. Now, you can also basically try to see if price will go a little bit further. And if not, then you end up getting hedged again, but then you would have $400 in your drawdown because you would be hedged twice. But it's a basic repetition of that same idea until you eventually recover that risk, close it out, and keep from losing the equity in your account. Alright, hedging is best used in one situation most effectively. And this is in situations like I just showed where a reversal is most likely to occur. Now, the second best time to apply hedging is when the markets are consolidating for a long period of time and where price is likely to be reversing in small but not very tight ranges. Now, if we're talking about basic trading concepts, we obviously know that we don't want to have too tight of a stop loss. So that kind of concept still applies to these type of situations in the market where it's just ranging up and down. I mean, if it's ranging 30, 40, 50 pips, it's a low probability that you'll have some success with it unless you have a successful strategy for it. But this could be a moderately effective way of applying some type of recovery to the hedge. Now, just like the example I just showed you, if that were to continue and price never reversed, that would be a situation where the market is trending for a long period of time, and you don't really want to be in this type of situation with trying to hedge, because like I just showed, is to protect a loss, and only one side of the hedge can be in a positive direction at any time. So, a market that's constantly continuing against the side. So like in our example, we had a buy at the first place where we thought price might reverse. And then, it didn't. It fell through. We got hedged. We had to protect that 80 pip loss. We thought it was going to reverse again, so we closed the hedge out. It did start to come back, but and instead of closing out, we went ahead and tried to get a little bit more and got hedged again. And basically, each time that happens, you're just going to add more and more risk, and the original position will not basically get any effective forward progress in order to be able to recover what is constantly losing. So you mainly want to try to hang on to that until you get to either this situation here or this situation here. You want to have some type of clear way of where it's going to reverse, because that's when you're going to be able to apply hedging the most effectively. So why do we want to hedge in the first place? We just simply want to stop the loss of equity. That's, in a nutshell, the most basic reason why you want to hedge. The added benefit of doing that, though, it'll also give the initial position, like our buy example, a second chance to succeed and make an additional gain, or at a minimum, we want to just recover that risk loss to drawdown when open but failed the first time. Now, when going back on that second chance to succeed, as long as you planned ahead and you have a plenty of equity to work with and you have the right kind of strategy, more on that later, you can basically create several of these second chances. So you can have 5 or 6 chances for a trade to actually succeed. But we'll get into that more later. So now, some of the things I'm going to be referring to when I get into some of the more advanced techniques in the video and on down the line, especially when I start discussing strategy, trimming, some of these other things. This is a lot of times going to be somewhere nearby on screen or referred to some degree. So you may want to try to grab a screenshot of this. This is basically where the money is going. Now, basically, any and all trading requires some sort of risk. That risk is a part of your equity, which is what's in your pocket. So basically, once you take part of this equity and add some risk, so like you put on a trade, you want to buy. So let's say, for example, you put in a little bit of risk here for a buy. Okay, the only way to get this money back out into your pocket must reach a target for profit. It can only go up there, then it will go back into your pocket. Then you start a new trade. You put risk. You use part of the equity to make a risk for a position. And let's say, for example, you're hedging. So now the price will come down. It gets hedged. Now that goes into your drawdown. It has not left your account just yet. You still have it, but you're still able to work with it. You're able to take a second chance with it. You're able to wait for another reversal opportunity or wait for another opportunity where you can get some type of forward progress to regain this right now unrealized loss in your drawdown. As long as you still hold that trade in your drawdown, you have not lost. The trade is not realized. And that's one of the main reasons why you want to hedge. You don't want to realize that loss. You want to try to work with it and at a minimum get what went into drawdown back to your equity. The equity is going to be your most important factor. This is going to always give you the ability to open new positions. It'll allow you to get your risk back into profit, because we all know, of course, you need to risk in order to gain. And every time you put risk into equity and go to profit, it's going to raise the amount in your pocket. Every time it goes from equity into drawdown, either by a hedge order triggered or by a stop loss. From the next part, we'll get to that. Let me not get too far ahead. But when you basically get a hedge order triggered, or you basically just have a position of a portion of your risk against a position that is not positive, it has no sort of gain at that point, that would then be working it into the drawdown. Now, once you hedge out and you stop the loss in equity, now your risk is in drawdown. Over time, your commission, your spreads, your swaps, your trading cost, your rollover fees, so on and so forth, they are going to accumulate more of your drawdown, and they are sourced out of your equity. So every day your swaps and rollovers are going to lose a small amount of equity into the drawdown. Now, the whole idea of hedging is to not lose, and we don't want to realize a loss unless we absolutely have to. So when it comes to some other techniques, such as controlling our maximum drawdown and controlling our account size, something we'll get into in later videos, basically we want to wait and do this until as late as possible. The reason we want to wait is because once we cross from drawdown to loss by closing out part of the position, which is a lot of times referred to as trimming, is basically the same as in one-way trading, where it would be a stop loss. You are basically saying right there when you close out that you give up. You no longer will not attempt to add any more risk from your equity of the equation to try to recover this drawdown. You give up. You do not want to attempt anymore, so you close it out. This then becomes a loss, just like any other trade, and it belongs to the market now. It is gone forever. This is how the money will be flowing in your account as you're opening and closing positions. The way you expose your risk. Once you, like I say, I mean, the most important thing is once that risk goes in, the only way to get it out is either with a target in profit or recovering the drawdown back to a positive equity to close it out. That's it. So, I mean, hedging is not a method of making sure that you always win. It is not a method of guaranteeing success. It is simply a matter of giving you your trading account, your equity, a chance to make forward progress. But no matter what you do, you have to be right in order to gain money. That is the most important thing. And by using hedging effectively, you can actually take advantage of its benefits to give yourself an advantage in being right more often. That's the entire idea of why you want to hedge and the whole purpose of what it is doing for you. It is not to generate profits, it is risk management only. Okay, that is going to conclude for the basics of hedging, what it's about, who it might be useful for. I'm going to continue to try to make some videos. I tend to do a lot of trading and get focused on trading. I'm new to making videos, so I'm going to work through this as best I can. But for now, just review these concepts and try to make sure that you have you understand everything about the basic hedge, because that basic hedge, the one where we stopped the loss on our long guess where it went wrong, we got hedged. This whole area here, we did not lose out of the account. We closed out that hedge. It came back at the amount that we had on risk up here. We closed out. We saved all of our money right there. We did not lose anything. And so we'll get into more concepts about that. But that is the basic building block of every structure in hedging. So just keep that in mind. You're going to see this pattern, this form. The same thing happens when you're starting to go short. You'll go, that's your short position. You think it's going to go. But no, boom. Big push because of a news event or whatever. Now you're hedged. Okay, so you got 20 pips. It goes some distance. It doesn't have to necessarily be 80. This is going to be determined basically by what you're trying to trade. I can show you some tricks to that as well coming up in future videos. But basically, this whole area right here where we normally be holding a loss, we hedged it out, we protected it, and then as price comes back, we only need it to come back this distance here, and we can close it out and save our account, or we can allow it more time to go, and bam, now we just closed down 23 pips of profit right there, or 27 pips, or whatever that might wind up being. So I mean, that's basically the whole reason of why you're trying to hedge, is to stop this part right here from tearing up your equity. All right. Thanks so much. I hope you enjoyed the video. I hope you get some kind of information and usefulness out of this. And to see some more videos like this, just check back in, or you know what to do. Give a subscribe and a thumbs up to help get it around. I'm going to try to give you my understanding, like I say, of the market, and tell you how show you how I'm looking at things, how I see it, some strategies, some tips. A lot of things I've learned over the years. I've got several years in the market. I watch price charts like more than most people are willing to sit down and watch Netflix and Hulu. That is my entertainment. I live for the time the market is moving. When the market is not moving, I am a very bored individual. So I live, eat, sleep, breathe trading. That's all I'm worried about doing. That's what I want to focus on. And hedging is one of the best methods of controlling risk, I feel like. So that is what I'm going to try to teach on this channel. Thanks so much. I'll see you on the next one.